Welcome. So today is April 20th, 2023. And in this video, I'm not going to watch the stock market. I'm not going to place any trades. I'm not going to do any of that. In fact, I'm going to go over a little lesson. I'm going to go over risk management. And why is it important? Is it even important? What is risk management? So let's start off with, is risk management important? Let's start off with what is risk management. So risk management is basically knowing when to close out of a trade, knowing where to put your stop losses, knowing how much of your account you can afford to lose if you're in a losing position. And we're going to go over why this is important, because this is what separates the traders who are in it for the long term in comparison to the traders who don't do it for a long time. Now, there is a statistic saying saying that 90% of traders fail and investors fail. Why is that? Why is that so? Why is it that 90% of people who get into this fail? I mean, based off of the statistics, you're probably going to be in the 90%. It's more likely that you're in the 90 than the 10. So what separates that 90 from the 10? And the thing is that when it comes to trading and investing, anybody can do it. Meaning there is no criteria to opening up an account, to funding that account, and to trading it. There is no criteria at all. All you have to have is money and an account and the ability to create an account, which everybody does. So if you're able to do that, then you can trade. So let me ask you another question. Here's another thing to think about. What do you have to do to become a doctor? To become a doctor, you have to go through schooling, years and years of schooling. You have to get your bachelor's. You have to get accepted into medical school. You have to do that. You have to do this. You have to do a lot of things, the same as a lawyer. Keep in mind that the third leading cause of death in the United States is medical error. So that's besides the point. Anyway, doctors, lawyers, all of these people go through training to get the job that they have and to do that. Now, would you allow a person who has no idea what he's doing to operate on you or defend you in the court of law? Probably not. It would be kind of dumb if you did. So instead of just jumping into the market, acting like you know it, or based off of something that you may have heard on the news, you would get into a stock. Now, yeah, you can make money that way, but the chances of you losing are higher. So in order to trade effectively, you have to know what you're doing. And a big factor in someone's success when it comes to trading is risk management. There's also a lot of other factors that play a role in this, but risk management is very, very important. So, what is risk management? And how much can you afford to lose on your trades when you're trading? So, risk management is basically before I get into that, a lot of firms, a lot of hedge funds, a lot of prop firms, they don't risk too much when they trade. A lot of firms trade and risk only 1 to 3%. That means that when they open their positions, if they are losing, if their account goes into the negative by 1 to 3%, they will close out on that trade, and that is a very small amount. They'll close out on that trade and they'll wait for a better setup. And the reason they do that is because they want to keep their losses very, very small or break even, or they want to make their profits very, very small or big. They would rather close out with negative $5 or $50 or $500, depending on how much is in their account, than closing and then waiting on a trade to turn around and hoping that it will turn around. There is no place for hope when it comes to this. When it comes to trading, you have to stick to your plan and you have to trade your plan, and you have to close out on losing trades quickly, because that is what will make you successful. Hoping that the market will turn around or that it will continue to go up if it retouches a level is a bad plan. You can't wish, or you can't hope that the price will turn around. The market is going to do what the market is going to do, and the price is influenced by other buyers, other sellers, market movers, banks, companies. A lot of other factors play a role in the price. So stick to your plan. You, as a retail trader, or eventually working for a prop firm or doing whatever, probably you don't have the money that banks have, so you probably won't be a market mover, but you can go with the trend. So let's say you got into this trade over here. We're looking at Amazon right now. We're looking at Amazon today, the beginning of the day, 9:30 a.m. As you can see, the market was going up. Great. If you got into a call, great. It jumped from 103 to 105. Good. $2 gain in about $2 gain, which is about here we go, about like, I don't know, 2%, and in a matter of 30 minutes, which is good. Depending on how many contracts you have, you could have made 200, 400, 600, 800, whatever, depending on how many contracts you purchased. Anyway, so let's say that you entered into a put over here, or you entered into a sell. You thought that the market was going to go down. So at the beginning of the day, you figured that the market was going to go down, so you were going to enter into that over here. Now the market didn't go down. The market went up. And as soon as it hit this level, you thought, oh wait, I don't want to take this loss. You don't want to take that loss, so you decided to stay in and hope that it would turn around. Now, as we can see, based off of this evidence right over here, it did turn around. So, but it's still not below our entry point right here. And it might go below our entry point, but as of right now, it's not. So you decide to stay in, and your losses got greater and greater and greater, and then maybe it turned around a little bit, but that's still a great loss. So it's a better idea the moment you realize, trading based off of my indicator over here, if it crosses our top line, then you should close out. It's a small loss, but you should accept the loss. Now, risk management also comes down to accepting loss. So I don't want to give a specific number when it comes to what you should accept as a loss. Because let's say you have a $25,000 account. You're trading with a $25,000 account on margin. You get into a trade, and it's going in the opposite direction that you want it to go in, and you're losing 1% of 25,000 is $250. I personally don't want to lose that much. If I was trading that much, I would only want to lose, like I wouldn't want to lose anything. But it really just depends on who you are as a person, and when you're willing to close out of these trades, and how you're willing to enter these trades. So I personally wouldn't want to lose more than $50 on a trade. I generally like to keep my stop losses very, very tight. And that price is going to be different for a lot of people. More people might be comfortable with being in a drawdown for a longer period of time. And me personally, I don't, but many people might feel more comfortable with that, and they might think that the market is going to go around, and it might work for them. And people trade differently. People trade with different setups, different indicators, different patterns. So this is what I'm doing. But as we can see, closing out with less than 1% or 1 to 3% is a good idea. just because it will keep your hard-earned money safe, and that's what you want to do. That's when you hear all the horror stories when people enter into the stock market and they lose everything that they have, and they lose thousands of dollars just because they didn't close out on their trades at the right moment. Now, in this day and age, it's a lot easier to monitor the market with cell phones, with charting software on our smartphones, with a charting software online. There's so many ways to monitor what you do. It makes it a little bit more easier and a little bit better. Way back when we didn't have cell phones and we didn't have smartphones and the charting software, and we had to watch a chart, it was more difficult. So in this day and age, things have become more simple, so it can be easier. Another thing when it comes to risk management is just being responsible with the amount that you're trading with. So if you have a $25,000 margin account, do not purchase 10 option contracts of a stock. If you are certain that it's going to go in a certain direction, you can take a risk and you can try, and you might be profitable if you know what you're doing. But trading the amount that you purchase, the amount of shares that you purchase, the amount of contracts that you purchase, the amount of lots that you purchase should be in alignment with your account size. With about $25,000, I wouldn't trade more than 1 to 3 contracts. I would wait until you multiply that money, have more in that account, and then trade more. You don't do this. You don't earn money by betting big at certain times. Well, you can, but you don't bet big all the time. You make money consistently. Kaizen. We want to Kaizen this. We want to make money step by step, incrementally. We want to incrementally grow our account when we have it at a certain size. We want to add more positions in there. We want to add more contracts, more shares, and then we want to grow that way. This is for the long term, so we want to move like that. Now, if you do see a setup and you're certain that it's going to head in the direction that you want it to head in, go ahead and add more to it. So with that being said, this is today's lesson on risk management, and I'm going to give you another little example. Let's say you entered into this. You thought that it was going to go up right around here, and it didn't. So you entered into a call right around here. The market turned around. Very possible. Many people might do this. You bet big. You went in big. You bought 10 contracts, and you realized that it was going to go in the opposite direction. So you ended up losing. Even if you had proper risk management and you closed out over here, you would have still lost a lot. So be careful when you're getting into your positions. Make sure you have you're trading with the right amount and you're closing out appropriately. So if I got in over here, as soon as it hit our top line over here, I got out. It's a small loss, that's okay. It's not a big deal. As long as you make more than you lose, it's okay. Yeah, losses suck and it's horrible and nobody wants to lose, but sometimes you might have to take a small loss. At the end of the day, you want to be green. You want to have a green P&L, and you want your winners to be a lot bigger than your losses. So with that being said, this is today's video on risk management. More lessons to come in the future.